Okay, so this is Bill Canada, Custer County Chairman of the Board of Commissioners. We're in a workshop with Sam DiNardo doing our first look at the draft audit for Custer County for this year. So it's a data gathering thing. Sam, take it away. Give us all the data you got.
Thank you, Bill. Okay. Well, as you can see, there is a lot of data.
Yes.
It's a 60+ page report. So I'll try to give you a good overview, things that I think are important to understand about the report and what information it's conveying to you. And as we go, if you have questions, I'll do my best to respond to those. Just a couple things before we get into the report.
Before you go on for, if anybody pumps in, just let me know.
Landfill keeps going in and out, so.
Okay. All right, go ahead.
Okay, I was just gonna mention, tucked inside the bound report, there's 2 letters. And we'll one of them we'll make reference to from time to time and maybe talk about certain elements of it separately. One of them is just an obligatory kind of communication to the governing board. It's required by auditing standards, and basically what it says, I'll explain draft too, Bill. But at any rate, what that letter says is it gives us an opportunity to convey to you areas where you may have had difficulties, but they didn't necessarily rise to the level of being included as an observation in the management letter itself. So you can do that communication verbally or by letter, but by letter is better documentation. So that's why you have it.
Great.
These documents are stamped draft, but that does not mean they're a work in progress here. Okay, what it is a recognition of is the fact that they are the county's financial statements. And so until all of you have had a chance to review them, ask questions, hopefully get answers to those questions, then we don't put it in final form. You will notice I've made some notes on my copy that I'm going to take with me. Every time I look through it, we find a typo or two. Yeah, there's little things like that. But the substance of the report is not going to change. So a little bit of the cosmetics and not much more.
Okay.
So having started with that sort of introduction, I'm just going to do a quick walkthrough of the main elements of the report, and I'll try to go quickly, but if I go too quickly and you have a question, then please, I'll pause and try to answer it. The first thing you should encounter is the auditor's report. It's 3 pages. And without reading that to you, let me mention that the key elements of the report are that A, it is what we now call unmodified. The lingo we used to use a few years and for a long time before that was whether it's qualified or not qualified. Now that term's been replaced by modified.
It gets kind of confusing before.
Maybe that was it. I don't know, but that's the term we use now. So it's unmodified. And in plain English, what that means is we think the financial statements as they're presented fairly present financial position and results of operations as they apply to governmental entities. And as we work through this, we'll see some things that are different if you're accustomed to reviewing financial statements for nonprofit or for-profit enterprises. This is a different sort of presentation, and the accounting protocols and disclosures are also different. So having said all that, it takes us 3 pages to say that now. You also have a circumstance this year, as in the last few years, where we have federal grant monies that we've received and expended in excess of $750,000. When we have that, you're subjected to what we call single audit rules. So simply said, that requires that we not only identify all those federal grant programs that we've had spending against, but we have to do testing for compliance. And without getting into all the background, essentially what it means is we test what has to equate to about 40%. Okay, not less than 40%. Some circumstances, it could be as little as 25%, but ours is 40%. Now, these rules apply to you, and they're subject to some additional reporting that we'll get into later in the report. That's all in what we call a compliance section. There's a schedule of federal awards, which just means those grant programs we've had spending against during the last year. And then a report on internal controls as they apply to major programs, major federal grant programs, and also compliance. And that's where we would disclose to you if one or more of the programs tested turned out to have compliance-related issues, expenditures that were not allowable or something of that nature. And if that were the case, we would disclose it. It would be labeled as findings and question costs. We don't have any of those to report to you, so that's a good thing.
So
But
your
just
test is 40%, more than 40%.
has to be
you look at.
40%, yeah.
And then if there's no issues, then you're gonna let it, that's it.
Well, we include the reports.
I know the issues are already there.
Yeah, the reports say that.
Okay,
Now,
right.
accounting and controls and other things are a little bit different than compliance. Compliance is, all these grants have rules attached to them. What can we use the money for, and sometimes not only what, but in what timeframes. And so what we're testing for is to see if we've complied with those rules.
Okay, so,
Now, those rules are changing. I don't want to get ahead of myself too much here, but the threshold for a long time has been 750,000. It's moving to 1 million. And I don't know what it's going to be for you, for the county, for 2025, but in 24, it was a little over 800,000, right? 850 some thousand. So we were obviously over the 750, as has been the case for the last few years, but less than 1 million. My point being, if it were in that same range next year, then this additional compliance testing and the related reporting may not be applicable to you. So that's determined on a year-to-year basis, depending on your federal grant award spending. Okay? All right, we're gonna get past that report. We're get some more fun stuff. The next thing you will see is entitled Management's Discussion and Analysis. And that is identified by using lowercase Roman numerals 1 through 7. And this is a section of the report that statement readers oftentimes are interested in, because it's a bit of a synopsis of the detail in the rest of the bound report. And so it can hypothetically give statement readers some understanding of the county's operations, where we get money from, what we spend it on, and so on. All I'll say about this before I get to the others is that the financial statement tables that you see in this section of the report are all extracted from the body of the basic financial statements, and they're presented in condensed form. And so for that reason, I usually, in this kind of presentation, skip beyond that MD&A section and get to the actual financial statements. And the first of those you will find on page 4. It's entitled Statement of Net Position. And you'll notice it's a little different from the things you see internally, not only in your internal financial statements, but also in your budgeting. And that's because under the column that says primary government, that's all the activities of Custer County. Okay, so general fund, road and bridge, all the other funds that have revenue, expense, and provide services are consolidated and included into that column. And what's also included is long-term assets and liabilities. So you'll notice here there's a section that says capital assets, non-depreciable and depreciable, and non-depreciable in our case just means essentially land, buildings, equipment, and everything else gets to get depreciated. And long-term liabilities, you'll notice about in the middle of the page, and it's broken down into those due within 1 year and those due beyond a year. And there's footnote detail, which we'll get to, that kind of explains that. But my point, and what I want you to take away from this, is this statement is unlike anything that you will see in your internal books. It's not how you do your internal accounting, nor your budgeting, nor do you have to. This basically was designed and required by GASB some many years ago now to address needs, information needs by other third parties, such as bonding, underwriters, lenders, financial institutions, things of that nature. We also use full accrual accounting concepts here. Not cruel, but accrual accounting concepts, meaning that we estimate the value of any receivables or payables or other accrued liabilities, and they're included in this financial statement. So the one thing that's separate, you can see in the column to the right, is E911 authority, which is a component unit. It was created many years ago as a product of an IGA, and so it's included as what we call a component unit, even though it's technically not in the same way as we think of our other funds providing county services. So I kind of intended not to spend lots of time on this, but to tell you that you can see it's arranged in assets, liabilities, and we subtract from that, in your case, deferred inflows. Deferred inflows means, in our case, receivables that will generate cash flow revenue in subsequent years. Okay, the largest of those is the ad valorem tax that is generated from the mill levies you certify late in the year for taxes to be collected in the ensuing year. So technically it's a receivable. It's included in the receivables total up on the top. But that revenue is not available to you until obviously we begin collecting it in the next year. And so hence the deferred,
$3 million is not,
deferred inflow.
it's not there, is that what you're saying?
Yeah,
Well, at December 31st, it wasn't there. Yeah, so that's true. But not to skip around a whole lot, but since we're on the subject, there is a little more detailed information starting on page 26 in the footnotes. And you can see a little recap of the receivables by each fund. So in the general fund, taxes, most of that bill would be property tax certified for collection in the general fund, but not everything, because we do collect other taxes there. SO tax and sales tax, both, for example. So it's a little recap by fund, but to the extent that it's dependent on the property tax payment calendar, those are considered deferred inflows. So we subtract deferred inflows to get to net position, so that you can think of as your equity on this full accrual accounting basis. And it's broken into 3 categories. You see investment in capital assets, net of related debt. So simply, that's the capital assets from the asset section up above, which was about 8.3 million. And then we subtract from it long-term liabilities that are still outstanding that have to do with the acquisition of those assets. So things like lease purchase arrangements, for example. One we did last year was on the compactor for the landfill. So the compactor for the landfill is included in capital assets. The remaining obligation is included in liabilities and so on. So that's how we get the number for investment in capital assets net of related debt. Restricted means just what it says, but I will mention from a definitional standpoint, restriction for this purpose means only those that are imposed upon you, imposed upon the county from some external requirement. Things such as Tabor Reserve, for example, is included in that total. And we have many other restricted resources too. So for instance, we have voter-approved taxes that go into Road and Bridge Fund, or Capital Improvement Fund, or the Lodging and Tourism Fund. Well, those monies are also restricted because the ballot questions posed to the voters said what we had to use the money for. So any residual balance is considered restricted until it's used for its prescribed purpose. Okay? And unrestricted means just what it says, no externally imposed restriction. You will notice in this section, there is no room for those where we might designate internally a use of certain funds. And we'll get to that when we look at the balance sheets for the governmental fund types, and that will make hopefully more sense at that point. The next page 5 is the second of what we call government-wide financial statements. And we have to turn it in landscape mode so it's still readable. Yeah, still readable. And once again, this is full accrual accounting. We start with expenses in these broad functional categories, we call them. And you can see general government, public safety, streets and highways, and so on. And we subtract from the expenses charges for services. So some activities we charge fees, for example. So that's what goes in that category. And we have grants that are used for supporting operating activities. For example, salaries, benefits, materials, and supplies would go in that category. Grants that either are or can be used for capital expenditures go in the next column. The sum of those program revenues then reduces the expense, and you see governmental activities column, all those categories with bracket amounts. So what that means is there's a cost that we have to pay for by other means. And if you follow down that column, that other means is all the otherwise undesignated tax revenues. You see property taxes, specific ownership taxes, sales and use taxes, highway user tax, and so on. So good thing in our case is all those general revenues amount to 7.5 million, as you can see. The net cost up above was the negative almost 6.4 million. So we had a positive change in net position, so our equity that we just looked at on the previous page, of $1,126,000. Now, this may not seem all that important to you because we don't manage we don't do our internal accounting in this way, nor do we manage our budgets in this way. But it is important to third-party statement readers. And so for that reason, hopefully this little description will help you understand that part.
Why does a third party care?
Well, they're making lending decisions, for example, or if we had a case where we had, say, voter approved bond issue, then that would affect the rating of the bonds and theoretically either the interest cost or the insurance cost to get the bonds issued. So
that'd be useful next year if we have to raise
so
money
that
for
would be important when we have folks like that looking at your financial statement.
Yeah.
Okay, we're about to get to some part that will look more familiar, I think, on page 6. This is balance sheet for governmental funds. So if you study this, what you'll notice is the long-term assets and liabilities that I made reference to a little bit ago in the statement of net position are not presented here. This has more of a working capital sort of point of view. It's more in line with how you think of your budgeting, the money that we get in and what we use it for. And you'll also notice that the first 4 columns are for general fund, road and bridge, human services fund, and capital improvement fund. And then we say other, and that is not because we ran out of room. Okay, the reason for that is those first four, or what we have to present separately because they're considered major funds. A major fund is not have anything to do with its importance. It has to do with merely size. So dollar value of assets, liabilities, revenue, or expenditures. And so those four funds satisfy that test. They're presented separately. All the other funds that you're accustomed to looking at, budgeting for, such as EMS, Conservation Trust, and so on. They're all grouped together, but there's detailed balance sheets that look just like this one in the supplemental information, and that supplemental information is first found on page 39. So easy to go back and look at each of those individually. But kind of having said that, let's look at general fund is where we have the most discretion, you might say, because that's where otherwise mostly unrestricted revenues are received and spent to deliver county services. You'll notice all the others, road and bridge, human service, and capital improvement, those are what we refer to in our lingo as special revenue funds. And there's a reason for the term. It simply is that they're created because we had a revenue stream dedicated to that purpose. Okay, so as an example, road and bridge. We'll see, I'm telling you something you already know, but you'll see on page 8 where we have revenues and expenses by each of these funds. That's driven by tax revenues. Okay, those tax revenues have to be received into road and bridge fund, and they have to be spent from road and bridge fund. The main drivers there are the ad valorem tax that we certify, 5 mils goes to the road and bridge fund. Because it gets a slice of the ad valorem tax, it also gets a slice of the specific ownership taxes that go with it. And then, of course, highway user tax money that funnels back to the county through the state also has to go in there. So, because of its unique purpose, those monies are restricted to use in road and bridge. It cannot be redirected to other funds. And that's generally the case when we're talking about these other special revenue funds. And if you think about it, it makes sense. Human Services Fund, same thing. We have a shared cost there. Some of it's generated by our own tax revenues, some from the state, occasionally federal monies as well. But nonetheless, all have restrictions on their application and use. And so for that reason, if you follow down the columns on page 6, the balance sheet, and get to the fund balance section, you'll see we don't just have one number like the old days when it was easier, right? Now we got potentially 5 different ones. And you can see non-spendable, restricted, committed, assigned, and unassigned. So what does that all mean? It's explained in the footnotes, but I'm gonna keep you from having to read that by saying non-spendable means it's money that's already committed, okay? Or it's not in a form that we can spend it again. So just look at general fund and road and bridge columns. You see non-spendable 14,590. And if we look at the assets, you see prepaid expenses 14,590. We've already spent it, right? Can't spend it again. It's simply a recognition of the accounting period that the cost will be recognized. In the road and bridge column right beside it, see inventories of 159,435. Well, we've spent the money. Okay, it's inventory that road and bridge department needs for
So what's the
equipment,
date?
vehicles,
Date
and so
date
on.
on that?
All of these are the values as of December 31st.
Okay.
Yes,
So
that's
you're
right.
expecting to have spent that amount by that time.
It's already there. That's the value of the physical goods on hand at that time.
Yeah, that's what I meant.
Right, yeah. So that's what non-spendable means. Restricted in this case has the same meaning that I just mentioned in the statement of position. Means that it's restricted by some external requirement, some provision in the law, statute, contract, grant, but something that we have to live up to. Okay, that's what restricted means.
So if Joe Blow on the street wants to know what's non-spendable, can we find the $14,000?
Yeah, you look up in
How do
the,
you
let's
find
look at the general fund, let's look at that column. And you see right before total assets, the line above that says prepaid expenses, 14,590. That equates to the non-spendable 14,590 in the fund balance section.
Yeah, but what is it spend it on?
What is it spent on? Well, typically, there are things like,
Can we find that through?
of course, it's in our accounting records, but we don't list each
I know,
transaction.
but all I'm doing is trying to, if somebody asks me, cool,
Typically, it would be
Was that for
things,
a bunch of
an
tires or
example,
somebody that
no,
had
no,
broken
it wouldn't be inventory.
okay.
It would be, in the general fund, it would be more things like we have renewals of insurance
No, I get
and
that.
things like that.
But you
We're
could
prepaying for a
actually trace that
subsequent
right
period.
back, theoretically, I'm just making sure I can speak the Lord's word here when somebody asks.
Sir, can I give you an example?
Go, yeah,
As of December 31st, which is the middle of the pay period, we always pay our health insurance a month in advance.
Yeah.
So what that would, so one of the things that could make that up would be the expenses that we had paid on December 31st for January of
Got it.
next year.
no, I understand.
Shows the obligation.
Yeah.
Yeah, I just want, okay, I understand enough to be able to handle that question.
Okay, good. Let's see, we were still talking about fund balance. Restricted, I mentioned, is the same definitionally as we talked about on the statement of net position. Committed, you'll see the only place that appears is in the general fund, and you do actually have some committed fund balance, as it's here. We have two drivers there in our case. It's monies that the Board of Commissioners has previously recognized as what you call landfill expansion fund and the Judicial Center. So when we've identified revenue streams that are not otherwise obligated, and we've had the discretion to do that, then those are what we call committed. They are not restricted because in your collective best judgment, if they were to be, or you thought it was, you had a higher priority for some reason, they could be redirected to another cause, a higher priority. So in other words, that's up to you. But that is required to be done at the Board of Commissioner level, okay? Not just built within the body of a budget, say, for example. So if you change the commitment, add to it, approve expenditures from it, or change definitionally what you want to use it for, then the Board of Commissioners should adopt a resolution to that effect. But that's what committed means. Assigned, I mentioned to you, and assigned, you'll see, always appears in these special revenue funds, and it's a residual balance in those funds that's not otherwise restricted. Okay, but because it went into a special revenue fund, pretty much has to be used there. Okay, does that kind of make sense, hopefully?
Is that our emergency fund, for example?
Well,
Right.
you're right. If we go to, the detailed balance sheet for the smaller special revenue funds, which I mentioned was on page 39. When we see we have assigned fund balance in contingent fund, emergency service, I think you mentioned, Bill, would be also true, and in the airport fund. So those three. Okay. The rest is either restricted or non-spendable in those special revenue funds.
Contingency fund, yeah, that's what I was looking
Right.
at. Okay,
Okay? And then unassigned means, well, just what it says. Okay? It's not subject to, it's not non-spendable, obviously, and it's not subject to one of these other restrictive categories. You'll notice that unassigned fund balance appears only in the general fund. okay? One observation before we kind of scooch to the next couple of pages is, you'll notice fund balances across the board here are all positive. Okay, so we have no condition where we had a deficit fund balance in each fund, or in any fund. And,
We did last year, so we fixed that.
I can't remember if it was last year or a couple years ago. We have
Just a small
occasionally,
amount, but
hey, we have had that occasional from time to time. That's been rectified.
yeah.
So as of the end of '24, we had no such condition. What the state's rules are is you're not supposed to, as a local government, have a deficit fund balance in any fund. And if you do, that you take corrective action, which we did. So as of the end of '24, we were in plus territory in each of the funds.
Yeah, good.
So. Page 7 is a reconciliation of the balance sheets we just looked at to the statement of net position. And it's a recognition of the differences in the reporting convention, long-term and accrual method for statement of net position, and not so in the general fund. So page 8 is where we look at revenues and expenditures in each of the 4 major funds, and then once again, the smaller funds combined together in the other governmental funds column. Just a couple things maybe to point out. Let's focus on a couple of these. General fund, for example, total revenues for '24 were $7,401,130. Expenditures, $6,675,000. That excess was $725,750, but we had transfers to other funds, $457,229. So some of the excess was consumed by shifting monies to other funds. Those other funds in our case were capital improvement, $204,000. 50,000 to airport fund, and 202,299 went to the insurance fund, which is the subject of a separate set of pages in here, not included in this governmental fund balance sheet and revenues and expenses. And proceeds from leases is a term that they use in the standards, and I don't like it, but they didn't ask for my opinion on it. The reason I don't like it is it leads us to believe there's actually money you got, and it isn't money you got. It's a recognition of the fact that we've entered into lease agreements during the year, during 2024, and we have an obligation to make payments on those leases in subsequent years. So it's the financed portion of a lease. Okay? It's not really proceeds like we got money. So let me pick one here that hopefully is the easiest to understand because it's the largest. If we look in the capital improvement fund, you'll see proceeds from leases, 600,000. So I'll tell you exactly what that was. That's the compactor for the landfill. And that cost to us was about 680,000. But we didn't pay the whole 680,000. We had a down payment of about 80,000. And the remaining 600,000 we'll make payments on in the ensuing years. The first of those is in 2025 and so on. So when we have these long-term agreements, the accounting convention is we recognize the financed portion and label it proceeds from leases, and then you might ask, well, where does the other side go? Because these things have to balance, right? And the other side goes as an element of our capital outlay. So you see, let's just focus on the capital improvement column. Capital outlay, $1,153,331. Well, that includes the finance portion of this lease. So you kind of inflate the capital outlay item by this finance portion, we're recognizing the fact that it's really not proceeds, it's a finance portion that we're gonna pay in future years out of subsequent years' revenue streams. Okay,
That
is
would be
that
the 600K in this case.
exactly right? Yes. Okay, does that
Okay.
sort of make sense to everyone? So, sometimes when we have transactions like this, the subject of the leases are not great big dollars. This one was. And so we don't do a whole lot of those, but my next point here that I discussed a little bit with Commissioner Epp and with Vernon is that you might change the style slightly of your board resolutions when those are approved, so that the board resolution identifies the total equipment cost and then the amount and source of the down payment, and then the remainder that has to be the subject of the subsequent years, the finance piece.
Sitting there, 600K.
Right, and then include an acknowledgement, a recognition of the fact that we have large transactions like this and we have to include the whole thing in capital outlay. It likely requires a budget amendment. So just simply include the budget amendment all in a single resolution. So for whatever it's worth, you can do it in different ways, but
We need
that
to
is
do
an
that in
easy
other
way
cases if we can.
to tie it all together,
One
and
time.
then hopefully everyone can understand the nature of the entire transaction, not just, well, we got down payment money from here, but where's the rest of it get recorded and paid from? So,
Does that work on another resolution instead of doing two, one to do it in and one to put it in the other fund?
Yeah, it's also much more
Save some
transparent.
time.
Yeah.
Time and energy and transparency.
That way you don't have to look for the other side of it. It's all in one resolution.
Yeah.
Yes, sir.
exactly. So going back to general fund, we kind of got sidetracked explaining this other finance and use category. But when we subtract that out, we had net change in fund balance. So a way to express that is all the revenues, all the transfers, all the pluses and minuses having been taken into account, general fund revenues exceeded expenditures, resulting in an increase in fund balance of $404,917. That's how you read this statement.
Net change.
Okay, net change. We don't use the term net profit. This would be as close as we come to that,
We're not a
governmental setting.
profit organization.
Right, labeling is different. Exactly. Okay,
Okay.
questions so far? Okay. Page 9 is a reconciliation of this statement, revenues and expenditures, I should say, to the statement of activities that we looked at, one of the second of the two government-wide financial statements. And so all you can really need to probably understand about this is total change in fund balances, all the governmental funds was $797,552. I'm at the top of page 9. And we simply explain the things that we either add or subtract to arrive at the change in net position that we looked at on that statement and the statement of activities. So it's a reconciliation, simply said.
So we increased that one.
Okay. What is labeled here as the internal service fund, you can see it consists of 3 pages. It has a statement in net position, a statement of revenues and expenses and changes in net position, and then a cash flow statement. And the reason this is presented is because generally accepted accounting principles that are promulgated and approved by GASB says that insurance funds be considered internal service funds. So they're not governmental funds like we just looked at. And because of that, they use full accrual accounting. Full accrual accounting requires a statement of cash flows. That's simple. Okay. That's followed by fiduciary fund financial statements. So It has a statement of net position, no statement of cash flows, because its perspective is different, but it does have a statement of changes, and you can see it is very uninformative, right? It says, this is the cash, and this is the money we're holding for others, because let me tell you what this represents. As you all know, our county treasurer collects monies that are obviously for the county's use and its various funds, but also collect monies that have to be distributed to other taxing entities. So for example, the schools, towns, and so on. And so all this means is, as of December 31st, there was $242,595 that had been collected, not yet distributed. Is distributed, most of it, early in the next month. For example, property tax collections have to be distributed by the 10th of the following month. So there's always this little time delay.
So that's what we end the year with.
Right. And page 14 just says for the whole year, how much did we take in and how much do we disperse and what's left over. So
Is that a combination of restricted funds, though, right?
well, this would actually all be restricted.
move
We
this
have no ability to use any of this money. This is simply what the
Okay.
treasurer collects
Yeah,
on
got it.
serving solely a fiduciary role, collecting that money on behalf of other taxing entities.
That's right.
Okay, so we have no ability to use any of that money.
But is it bucketed so that 242,000, they know 10,000
Yeah,
goes to
and
the fire
actually,
department?
actually you get a report on that from the treasurer's office, and then you can give, if you remember
say
the list of all these different activities.
Yeah.
Yeah, and the ones that don't belong to us, I guess you might say.
Yeah, mixed.
is
When we get the
all-
report, it's a mix.
Yeah, it's all mixed together when you get it, but the ones that don't belong to us, the county, is the subject of this report.
Got it.
Okay? The notes to the financial statements start on page 15. And they go on for a ways. 37 or 38.
17 pages, huh?
Yeah, maybe not that bad. Maybe only page 34, not so bad. So,
Great.
so I don't mean to make light of them. They're all important information. Okay, they tell about the accounting protocols and also disclosures that are pertinent to the county. And so they're all important. But lots of them do not change from year to year because thankfully not everything changes every year. They are updated for dates and amounts. And so because of that, I don't want to skip them entirely, but just maybe highlight a couple things for you. One of them would appear, let me flip to the right page, if I may, on page 23. So there's not the subheading at the top dealing with estimates, but the first one after that, adoption of accounting principles. And I make reference to two different statements that had become applicable by GASB, numbers 100 and 101. And we say the county implemented the following pronouncements. Well, you did. Statement number 100 says accounting changes and error corrections, and it's an amendment of an older standard. Well, we really didn't have that. That was easy to adopt for us this year because we didn't have any. Okay, so that was good. Statement 101 is a little different, and that did require some additional work. It's some updated guidance on how we measure and disclose what they refer to as compensated absences. And simply put, what that means is leave time that county employees have earned but not yet used. We're transitioning from an older policy that had sick leave and vacation concepts to one that is going to be fully PTO. But this standard applies to both concepts, okay? And then, as you can see, Gatsby's been busy, so I decided to include in the disclosures here, kind of as a memo, some other things are coming down the pike. Statements 102, 103, and 104. And we will have implementation on those in the ensuing years. Number 102 has to be implemented for the year we're in right now, 2025, and it will deal with some additional disclosures. And reporting model and capital asset disclosures are going to be updated, and those have to be implemented in the following year, 2026. So that seems like far away, but it's not. It's 3 months.
Were they involved? It just says it's gonna happen.
Well,
Don't give me a,
yeah, that takes a little deeper dive here. Most of what we're going through
are we gonna be
here,
able to implement it easily, or is it gonna have to require a new computer system?
no, thankfully, no.
That's what's happened in our past.
Yeah, thankfully, no. Reporting model improvements are mostly what we're seeing here. So the style of presentation and some of the information and the disclosures will change.
Okay.
And so most of that will be, other than when I pointed out to you, probably things you might not really,
Care about.
well, you would just wouldn't
Or
be, it
impact.
wouldn't be so easy to spot, let's
Yeah,
just
okay.
say, okay? It doesn't change, however, your perspective on how you go about accounting for these different funds, all the ones we've been talking about, how you go about your budgeting, all that's still very similar.
If you
going
didn't do it
forward.
correctly, do you get gigged?
Well, if you didn't,
If
I
you said
suppose
that
you,
if
I
it
suppose
doesn't
you would.
impact your
yeah.
financial position.
Yeah, I mean,
You're gonna get
if
penalized
some
anyway.
condition came about that they could not be implemented,
Yeah, but
then we would say, GASB number, whatever one it
Was
is,
not adhered
hasn't
to.
been implemented yet.
even though the numbers don't change and we're still being
So,
all,
at this point, let's just say, I don't expect us to have a condition where we could not implement any of these
Yeah,
three
if that
standards.
were to happen.
Okay,
I'm thinking it must be Kiowa County to do that.
well, I
Blame
don't
somebody else.
speak to any other ones. Speak to any other ones. So that's one thing to point out to you.
Okay,
Page 25, note 3 takes up most of the top, dealing with cash and investments. And it's simply a synopsis of where we had financial institution deposits or investment accounts, and a reconciliation of those amounts to the balance sheets that we looked at earlier. We looked at note 4 that starts at the bottom of page 26 and concludes on the top of page 27. And then we get some really busy looking stuff, starting on page 28, note 7, capital assets. So that appeared in the statement of net position. You remember the two categories that were depreciable and non-depreciable? Well, this is a further breakdown. You can see land, anything that, assets in progress just means we may have started on building or constructing something or raising money for that purpose, but hadn't completed it. So that's what that means. And then all the other assets we do depreciate. So all those are straightforward enough. I just wanted to point out a couple things to you. If you look in the depreciable assets section, so just follow that down. You'll see building improvements, vehicles, and so on. You'll see leased assets and subita. Okay, so leased assets are not the kind of thing that I just talked to you about on the compactor, because it's called a lease, but at the end of the lease term, that compactor belongs to the county. These kind of leases are those things that we previously considered rental arrangements.
now we got it.
And we've had them all along, but the accounting treatment had to change a couple of years ago. Okay. And it's typically things like office equipment, copy machines, Copy machines is a great example, because oftentimes we rent it for 5 years and then get a new one. Well, now if it's a multi-year agreement, we have to estimate the net present value of the required lease payments, and it's included as a leased asset. That differs from those arrangements like the compactor, where at the end of the term, we own the equipment, even though the labeling sounds very similar.
Never do own our copy.
No, and if we do want to keep one, it's typically a market value purchase at the end of the lease term. And then SBITA is an abbreviation because we can't fit the whole label in there. And it stands for Subscription-Based Information Technology Agreements. And it's the same exact standards almost as the leases I just mentioned, except the leases deal with tangible property and SBITA deals only with intangibles. Usually, we're talking about software and that kind of thing. Neither of these standards deals with nor includes service agreements. Okay, so for example, we might rent equipment like copy machines, and there could be a service agreement that goes right along with it, or consumption charges based on number of copies. Those service agreements or consumption fees are not included in these totals. Okay? So whether you knew it or not, Bill, you adopted that agreement in this last year.
That's amazing.
So congratulations.
I feel like I was an instructor at the Air Force Academy, and I think I could teach this to the program management class or an engineer now.
Good. Good.
No.
So the other section of note is note 10, starts on page 30. Long-term obligations, we call it. We don't call it debt anymore because you can see it's a lot of them really not debt definitionally, but they do deal with things we're required to pay or likely to be required to pay in the future. So notes payable and other, that's what we used to call capital lease agreements. You'll notice here, John Deere Finance and some with the bank, the vacant land for the judicial center and so on. If you look at the documents, they'll say lease on there, but really at the end of the term, the property is going to belong to the county. The reason it's labeled lease is because in Tabor, there's restrictions on long-term multi-year agreements that you can enter into. So all those are called leases because they have kind of an opt-out clause. And the opt-out clause simply says, if the board of the governing board of the local government chooses not to appropriate funds for that particular contract, then you don't have to pay it. Okay, so it's not a debt because of that.
How do you figure the asset value?
They're all by contract. For example, just on the compactor we were talking about, we had bids, we know exactly what the equipment cost is.
When we started, but when it depreciates, then we gotta find out. In this case, the land would appreciate. And then you would, the next year, that would be
Yeah, we don't do that. So that's a good question, though. In this fixed asset accounting, facilities that we use, and most of the time we are talking about real property, land and buildings, that over time might become more valuable than when you initially acquired them. I mean, that's the most common scenario. But we don't recognize an increase in that value.
Okay.
It's carried on your books at its original cost.
Cost.
Right, at your original cost, or in some cases, if we had donated items, which we do have sometimes, those are at their estimated value at the time of the donation.
Okay.
If it's things like equipment or even buildings that we're using, tangible property, then we depreciate those. We use straight line method depreciation, and we use service
10
lives.
years, 5 years, whatever.
Depends on the property. Buildings, for example, would be probably 40 to 50. Equipment would be between 5 and 10, 5, 7, or 10 usually. The guidelines we use have been developed by the Government Finance Officers Association, GFOA. It's done studies about the estimated service lives of different assets used by governments.
Okay.
So that's the guideline. It's not at all like what you might think of in your tax reporting or something like that. This section here, note 10, dealing with long-term obligations, though, is not the asset value. This is a summary of the changes in the remaining obligation. Okay, so let's take that first one. First line says notes payable and other. We started the year at $780,000. We increased it by entering into the transaction for the compactor, $600,000. And then we had payments against principal of $123,828. That means at the end of last year, the remainder is $1,257,036. And if you follow down to the little listing below the table, you'll see a brief description of each of the contracts that were still outstanding. And lo and behold, that subtotal, $1,257,036, matches the number in the tables. That's what it's supposed to do. We wrench it in there. Yeah, we wrench it in there. So those contracts you're familiar with. Leases, right below that is these rental type arrangements, copy machines and so on. And we don't list them individually because you probably got a couple of dozen of those that makes up that total.
Hard to conceive, leave, or sick leave is a lease.
Well, no, leases are leases. Subscription-based IT agreements is that SBITA that I just mentioned to you. Compensated absences is what you would now think of as we're shifting from vacation and sick leave definitionally to PTO. And other obligations, estimated, you might have skipped ahead of me, Bill. Estimated closure and post-closure costs, solid waste landfill, $1 million. So where that comes from is, every so many years, I think it's 5 years required by the regulations now, engineers have to come and give you an assessment. And there's a cost in federal law, and that cost is an estimate of what it costs to cover any landfill that's presently being used, and then a maintenance cost for the ensuing 30 years. So you don't just get to cover it and forget about it, as you know. There's a monitoring expense that comes with that. And that engineer's report estimates that cost and discounts those numbers to today's dollars, so a net present value dollar. So this does not mean we have $1,098,000 that we have to pay next year or the year after. It's an estimate of this total cost when we close any existing area that's presently in use, or at least was in use at the time the engineers were here. Their report was updated in October of last year.
Yeah, it was quick, and we had a problem getting there on time.
And then the post-closure costs. And lots of times that changes over time because the cost of cover material changes, area that we cover changes, compaction rate changes, I presume, hence giving rise to the new compactor. But all those factors are considered in their report. And that has to be included in our long-term obligation section, and there's a separate footnote dealing with certain other elements of the landfill operation as well. And you're obligated to include that in the report. That serves as your mandatory public notice. You have to do a public notice. So producing it in this audit report satisfies that requirement. Okay. On page 31 is a breakdown of the ensuing year's principal and interest payments estimated by category. You see the long-term obligations and the leases, then the subscription-based IT agreements. Page 32 is the obligatory disclosure on the landfill. And on the bottom of page 32 and concluding on the top of page 33 is a little synopsis of the fund balance categories that we talked about in some detail when we're looking at the balance sheet. Note 13 is required. It's actually money that we don't handle directly anymore. It's benefits that are provided directly from the state through the EBT system to people being served by the Human Services Fund. So in the old days, which doesn't seem that long ago, but we used to get the money, actually receive the money, and then would provide it to qualifying participants. Now, many of these benefits go directly from the state to the participants, but we're required to include this table in our footnotes explaining how much that was. Just to recap. Yes.
So where is it booked officially then? Some state office?
Yeah,
Have
the
same-
reports
they
come
all
from the
see
state, the
same
state's
thing, so-
report come from the
So we just ask
State
them for
Department
this?
of Human Services.
So they'll supply this, or do we have to track it before they?
Both.
I know we get it.
Both.
We get most, so they make
Yeah, I
us
mean,
do it.
they
then
send it.
We gotta make
and
sure
then-
they're right.
And then we usually have questions.
Yep.
This part right here is a huge part of Vicki White's.
Right,
I
I
know.
say Vicky's,
Yeah, and she's
she
did a
does
great
very
job.
well with that, at least what I've seen.
The footnotes are followed by what we label required supplementary information. So let me tell you what that means simply. There's several things potentially. In our case, part of what's required is budget and actual comparisons for the general fund and each of the major special revenue funds. So that's road and bridge and so on, we've already discussed. And what this does, let's focus, if we may, on page 35 for the general fund. You'll notice a column that has original budget amounts, and then you'll notice a column that says final. And the difference between the two is, as you work through the year, if you've made changes to your budget because you've had to adopt budget supplements or other amendments, then the original budget is amended for those changes. Final means after having given effect to all those changes you have adopted. It's those numbers then that are compared to the final actual numbers. And so that's the purpose of it. One of our tests, if you look about just below the midpoint, you'll see total expenditures. So sometimes we've had conversations in the past about, well, you're not supposed to spend more than your appropriated budgets. And so that is the singular test that we use to answer that question. So in other words, for general fund, final budget, $6,773,803, actual was $6,675,000. We were $98,000 less than our final appropriated budget. So we satisfied state statute in that regard. This is not a question about whether or not we had current year revenues or other resources to provide for the spending. It's simply, did we spend more than that total spending line item? It's not a question of whether we had, as you can see, we've already said you had an increase in your fund balance. So we know we didn't spend more than our current year resources. So we can very easily have a case where we were over our spending budget, but the reason we were, and oftentimes the reason we are, is because we had revenue sources that provided for that. So even though we may have the resource, you have to continue to monitor that, adopt budget resolutions to amend your budgets when it's appropriate. So we use that same test for all the funds, as you know. Okay? When we get beyond the funds that were major special revenue funds, we get into other supplementary information. We've already referred back to this a bit. The smaller special revenue funds, balance sheet, revenue and expense statements are followed by a budget and actual comparisons for each of those funds beginning on page 41. So there you will see contingent, CTF, EMS, airport, lodging and tourism, and the insurance fund. So even though it is not considered a special revenue fund, we're still obligated under state statute to adopt a budget for it. And so because of that, it's included in this presentation. And then somewhat similarly, page 47, E911 as a component unit has the same budgeting obligations that we have for all the rest of the county funds. And so they can and should adopt an initial budget in the same timelines that we do at the county. They are permitted to amend that budget when circumstances require that they need to. You can see that they did. This is the one spot where we still ended up with the actual expenses just very slightly higher than the final budget amount, $3,900.
What page are you on?
I'm on page 47. I'm sorry, Vernon, I kind of skipped quickly one page after another.
I was making notes and got lost.
Yeah, that's what I did earlier.
So at least I went in order. I didn't skip around.
Sure you didn't.
So that's the purpose of those presentations. Then we follow beginning on page 48. This is the sections that deal with these compliance-related matters that I described to you at the outset. This is entitled Schedule of Expenditures of Federal Awards, and sometimes you might be in a setting where people like me refer to it as a CFA. So that's what the acronym means, Schedule of Expenditures of Federal Awards. And you can see grand total at the bottom of the page, $879,399. We were in excess of the $750, giving rise to all this single audit testing and reporting that I described to you. That threshold is changing to $1 million. And then in the future, at least, we'll measure whether or not those rules apply to you based on that $1 million threshold.
But DHS was, I mean, they're a big part of it, aren't
They're a big part of it. The other thing in
they? In public
It's
health.
not.
I can't remember,
It's
one of you may have asked me this question in the past, but you know that PILT monies are federal monies. But there's a special rule that excludes PILT monies from this testing. So if we included PILT,
we'd
we'd
be
clearly
way
be way over $1 million,
Yeah.
but we don't have to include PILT. Okay,
I don't like including human services.
yeah,
That's
well,
not fair.
perhaps not,
Play fair.
but we got it.
We're just executing the darn thing for them.
Well, that's true, but in many respects, almost all these grants have a similar purpose, right? They all have a reason that we get the money, we're supposed to apply it to some function or purpose.
And we can't control that one because they set the wages, they set.
No, but that, you bring up a good point, and that point is this. That is the
They could
reason
overspend
this is the reason when we apply for grants, that they should be approved by our governing board.
Yeah,
Okay, because sometimes we may have restrictions on those grants that you may not like, and so you have a chance to debate that. Or sometimes we may have a matching requirement,
that's what I
and it
don't
may
like.
not
We get
be
surprised all
always
that.
agreed
We're gonna
on whether we
match
have the
that.
resources to satisfy the match.
Yeah,
So that's the reason that those should be approved at your level,
yep.
one of the reasons. Page 49 is some explanatory material notes dealing with the schedule of federal awards, which is followed by page 50. It's the first of two compliance-related reports. This one deals with controls, and you'll notice it's controls over financial reporting and compliance, but it's dealing with, you notice in the title, government auditing standards. Well, that's another way to say the single audit requirements. Okay, so it addresses only those programs. It's not county-wide. So we don't really have any disclosures there. The compliance section follows on page 52. And these are basically findings related to major programs that we tested. So I mentioned earlier on that we have to select programs that comprise at least 40% of those federal expenditures. Okay, so if you had just shy of 900,000, 880,000, so you multiply it out, we had to test at least $360,000 worth of expenditures against these programs.
How do you choose?
Dartwood.
Well, yes and no to a point. There's some rules though. If you have any individual program that was more than 750,000, which we didn't, but if you did, that would require to be selected. Okay, we didn't have any that large. So then you kind of work down the list. And down the list means we're usually picking the next 2 or 3 largest. Some of these programs, even though they have separate numbers on there, those CFDA numbers, are part of what they call a cluster. So they're sort of interrelated. And so you have to look at all the programs in the cluster. So short answer to your question, we probably end up looking for compliance-related purposes at about a half a dozen of these programs to get over that threshold. Page 55 is a continuation of this, and this, you notice at the top, it says schedule of findings and question cost. So we don't have anything to disclose to you that's a question cost. That is a good thing. If we did, what that means to the federal government is there's potentially something you spent against one of these programs that was not allowable. And if that's the case, they usually will follow up and ask you to send the money back or prove your point that it is allowable, okay? So we've had very little of that in the county's history, but we have had some. But we don't have any this year.
Tell me the definitions again that took the place of non-conforming and.
So I think what you're referring to is where we call our opinion letters either unmodified or modified, and the language we used to use was qualified or unqualified. But for all practical purposes, the terms are interchangeable in terms of what they mean to you.
Unmodified, all right. And we didn't have any non-modified.
No, not this year. So financial statement findings are in the bottom of that page. And you can see they go through a kind of a, it's almost like a Q&A. There's a cause, an effect, a recommendation, and a response. All of the things that are disclosed here. And let me back up just a moment. The things that are disclosed here are any findings that we have to communicate to you. They're in 2 categories. One is new observations. So in other words, something that we may have observed and need to report to you in 24 that we hadn't had that condition in previous years. Okay, so we have no new observations.
Okay, a little quick one here, it's not confusing, but I'm asking why. On that section 1, you got unmodified as a column, and what you got under there, you're just showing that non-compliance of materials, none was noted. So everything's unmodified here, but it looks like it's confusing that you got a deficiency, material deficiencies identified, yes. Weaknesses identified.
I see what you're looking at and why you asked that question. So let me go back and explain. What I just told you is all true, okay? Is all true. This little section here that looks like this check the box Q&A, that is required to be included in the reports that are submitted to the single audit clearinghouse.
Okay.
That's the specific question and language that's on their question.
For them to just.
So I don't even know if they do that, Paul, because now what we have to do is we'll go in as we initiate that submission and answer the questions in just this way. So they don't even have to look at
They
this,
don't have to look.
but they are gonna get the report.
Okay.
But nonetheless, we'll answer the questions in just that way.
It's a tricky question, because if they would have went no, then it would have really been a modified.
Yeah,
Yeah, the labeling, these are separate,
It says-
so I can see
You got
where
the
it gets.
deficiencies and you
So
say yes.
you see look at it this way, that right at the top, where it says type of audit report issued, unmodified.
That's what I said.
That's the
I
end
saw
of the
that and
story.
everything else
That is not a
It all
heading.
said it was modified.
Right, now I do, now I'm glad you said that, because now, that is not a heading for everything that is below it.
Right.
That's just an answer
Okay,
to the
that's what it's
question on
confusing.
that
Why don't you
line.
slide it over?
Okay. You know what? I don't think there's any rule that says I can't put a double underline there.
There you
I can do
go.
that.
Underline that, separate it,
that.
it's a new category.
it's up there.
Now I understand
Okay.
exactly why that seems so odd.
So
Okay.
you're down below, you got the same thing down there.
Yeah, unmodified.
Right, it's the same
Just
exact
fix that,
thing,
too.
but they're not headings.
'Cause it
They're
looks
just
like
an
another heading
answer
of
to
a different bunch
the,
of
to the question on
Looks
that
like a
line.
classification of.
Right.
Okay.
You know, I'm glad you said that. Nobody's ever asked me that before. But I can see how,
Pops out.
yeah, I can see
Yeah.
how it would be misleading.
It's a lot better than line up there.
Okay, I'm gonna put lines in there.
Yeah, I think of some sections with lines.
Yeah, I'm gonna put some lines in there. Nothing says I can't do lines. We
Yeah,
can do that.
everything above
Not
is
any statute I know of.
No. So, okay, now that we've got that figured out, section two deals with financial statement findings. Okay, so I mentioned a moment ago, I don't have new ones to report to you. But these are repeats of those things that have been communicated to the board, to the county in previous years.
And they're gonna wanna see us doing something about it.
So, yes, they
So
do.
it's a conclusion.
How long are we allowed to not do it?
I don't think there's any statutes, really.
I mean, we're gonna get to it, had it occurred in 1956.
Yeah.
Nope, because these single audit rules didn't exist in
I know.
But a practical matter, there isn't any number of years guideline. But just so you know how it works, we will initiate this uploading the report and answering this questions. At different times in the process, you will be prompted, not the commissioners, because Vernon's gonna do this on your behalf, to also validate some of those answers. Okay, so he'll just validate. But one of the important things that will come about from that is you have to upload an explanation of what you're doing to address these conditions. Okay, and that is what they're gonna look at. So, from my experience, if we are able to provide responses that sounds like they're a thoughtful consideration of what we either are or are intending to do to address these considerations in our circumstance, they'll usually accept that.
I'll give you.
But if they see something like, hey, well, you know, we're still working on it, and it's the same answer year after year with no detail about, well, what are you actually doing? Then at some point, they will press for more information.
So I got crucified, we all did, for a while, on not doing anything about the things that happened 5 years ago. We did try, we tried, people lost receipts back in the old days, and they couldn't find the receipts to balance it out, and we can't account for $7,000, let's say. And so, when do we get to stop being crucified for $7,000 we're gonna ignore and say we lost it?
Well, I can't speak to whoever's
I know they'll.
whoever's
but
doing the
legally, I just
crucifying.
wanna know.
So-
I'm sorry, I ignored it, but.
Well, what we can do is, folks, these things in this section here, and this really is the conclusion of the report, other than what we append for an updated road and bridge report, okay? That really is the tail end of the report. But all of these findings here pretty much dovetail with these things that I've included in this management letter. And in my view, it's easier to look at that and discuss what have we done or what have we going to
A little
do
more explained.
to address them than this condition, context, criteria. It gives us constraints that, the verbiage is the same on every one of them almost.
Accounts outstanding funds should be cleared on a timely basis.
So let's look at the management letter, because that, I think, is the best place to have this discussion from.
You explained that.
So, in the management letter, I break it down into two sections. We'll say current year reported, and you'll see I've said no new observations. Okay, so I'm conveying nothing new to you that I have not done so in previous years. That's a good thing. But that doesn't mean we have plenty of other things to work on after that. So, reported in previous years, and some of these, Bill, go back for more than just a single year, as you know. But let's just go through them real quickly. County should consider adopting comprehensive set of written policies and procedures, and I basically say things that seem like common sense. They should address financial transactions, record keeping, reporting in all areas, etc. Okay? Current status, in progress. I said in progress because I know that we have in fact adopted some policies.
I would like to see there something that says the county's done, adapted them, and 5 were adapted, 7 more being worked, or whatever the case may be. Would that
Kind of
help?
recap.
I would like to see that.
Well,
I mean, if you know that's the case.
I don't know that I have a tally on how many you've done and how many you
Well,
intend to do.
my point is.
I mean, I don't know that I can estimate for you like a construction in progress sort of a thing. We're halfway done, we're X. I don't know that I have that information.
Well, no, all I'm saying is Vernon could say, I took this from last year and my guys are putting together these policies on leaves, these policies on booking leases, these policies of, turning receipts in.
If I can speak to that point, Sam Bernardo mentioned that the state would ask about certain things from previous years. I spent a significant amount of time last year answering questions from the state and from the feds regarding findings from 23, 24,
Right.
25 into the past.
And you haven't done any policies yet.
I have done policies.
Well,
I have brought, I don't know if you remember, but I brought over 13 policies.
That's why I brought it up, yes, I did.
Yes.
That's why I would say just, but a simple thing that says, county should consider putting policy together, and your status is, they're doing it.
We are doing it. I have another 30 for you for approval
See,
soon
you
for
could
this
say
year.
that
so-
17 have been approved and 30 to come, something like
Instead
that.
of identifying certain items,
I know,
what
just-
percentage be better? We've completed 20.
But I can speak to Sam Bernardo's point is that I could die tomorrow and none of those policies
No,
would be
you're not
approved.
allowed to do
And so
that.
you don't, so he couldn't make a statement saying, hey, they've got 30 more policies that they're gonna process. But I will be bringing those to you.
No, I know you
They'll be
will.
reflected on next year's.
But Joe Blow, that these are gonna be open records, everybody's gonna look at it.
Of course.
Well, so you said you're gonna do them, what's the status? And they're gonna.
Well,
we're
that's
gonna have to go
that's one of those
figure it out.
questions you have to follow up on.
I know,
From
but
my
I'm not
perspective-
asking you to follow
I
it
know,
up.
but what I'm saying is, from my perspective, it sounds like it's a true statement, right?
Right.
In progress, we're not done.
Well, you met your criteria,
Okay.
but, they're in work, it looks like
So,
7
and
to
I
10.
think Vernon attempted to
You're not
give
saying
you an
they're right.
answer as to the progress. At this point, you've completed however many you said, 13 or 17. And we have X
Or maybe
numbers
then
that
what we
we're
do
working
is,
on.
say, Vernon, we want you to put an addendum together.
But since he's working on them,
But
I'm
what
sure
he-
he could give you a listing.
But what he could do in the office, he could say, companion with this, it says, of the findings observed, here's our status.
Let me also tell you, what I think is an important part here is that, and we talked about it in this context on more than one occasion in the past, is the county's changed. Things we're required to do, the size of government, the dollars we deal with, the different programs, all these things change. Our policies need to be updated in order to be able to deal with those changes. And so in some respects, this is never done. Because as you think about it, things continue to change, right? So at some point, it's never done. We want for you to have what you end up with, something that is workable, not just a big fancy set of policies that we stick on the shelf and we're very proud of. They don't do any good if we don't have the ability to communicate those policies to all the people that need to know and apply those rules. And then, of course, one of the important last steps is, do we have a system to ensure that they're working?
Sure.
So some monitoring function.
See, what I'm trying to avoid, Sam, is a core request that says, what have you done about your findings from 2017? You know, bottom line is, we're working them, we've got policies coming. But it would be nice for our department even to have a record that's an appendix, not appendix, but a companion to this document together that says, here's the status, not your report, not you saying it. You've observed that we're doing it. He's doing them. He could put a summary out so that a guy online can go click, 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 and then he pulls up this companion that says, of the findings in this report, here's the answers. So
Maybe a way you could do that, since we're just having this discussion, maybe a way you could, obviously Vernon knows which ones he's working on.
that's right.
You
Should
simply
be
have a
easy.
list, and aside from
He can
whatever
click them off as
brief
he's doing it.
labeling, you give a status or a timeline.
And every time we have a resolution and approve a new policy, he can update his appendant.
We can say, this one's adopted on this date.
Yeah.
So just an inventory. That would help
shows
you
it.
address
It would
that
help you in your
question.
next audit too, because you can say,
So-
you know,
I think that's fine, but this is all part of that
Right.
big picture. My point to it is,
good news
This-
is we're
this-
doing it.
I don't know how you take this, good or bad. It's never done, is the point. It's never completely done because
There's always something.
things will continue to change.
Sure.
And we have to
And that's
be
why
able
you
to
update
adapt.
it, and somebody can click, boy, this county's on the ball, the finance department's premier,
But
gold star.
something like that would
Round
help
point.
you be
World
able to
class.
understand how to respond to questions of that
Yeah.
nature. So I don't disagree.
Okay.
Item 2 deals with GASB 87. Now, this came into the rules. We were first required to adopt that in calendar year 22. As you know, we struggled with that for not being able to find and identify all of the lease agreements for evaluation. We implemented that standard in 23, a year late, but we did it. We've continued to comply in 24, and we will in the future. And I said current status implemented in 23, but inconsistencies remain regarding the ability to identify, monitor, and archive the necessary documents on an ongoing basis. In other words, still seems like we struggle from time to time getting our arms around all of the agreements that would be applicable.
We found them all. We just need to show how we did it, or how we're gonna-
Well, and I think we need to deal with the archiving function as well. Item 3, balances outstanding between funds should be cleared on a timely basis, in most cases not beyond 12 months. Current status is balance remains outstanding, which should be cleared. So, a little context. There were no changes to those balances during 24, so in that regard, that's tidier. But we did not take action to clear those that existed from previous years. Most of those came about in years 21 and 22, some in 23. I have a worksheet with a table that I'm going to leave with Vernon, so you know how much was originated in each year. The
So the
biggest
question that I've been
difference,
asked is, how do we know how much money we can't account for? Because if you can't balance it, you haven't shown.
I didn't say they didn't balance.
No, you
I
said you couldn't find it.
I said, and what gives rise to this, that's not a question that even addresses this observation in my view.
Okay,
Okay, what I said was we have compared to where the revenues have been received. So that doesn't necessarily mean we didn't know what we spent it on or where the money came from. That
that's
is
the
not
problem,
saying the
because
same thing. No, that is off base,
yeah.
okay? What we're saying
They
is
take
we
that-
deposited the funds in an account that was different from the fund that we spent the money on.
Yeah.
Case in point, we had grant-supported capital expenditures. The expenditures were made out of capital
Yeah.
improvement fund, but the grant revenue was
Got it.
receipted into the general fund.
Bottom line is, like, the big
Okay,
picture is. money
that
came
doesn't
in
mean that
X,
we
money
didn't
came
spend
out
it where it was
maybe.
supposed to go. There's
Yeah.
there's a very big difference in
Yes.
those statements, and
Yeah.
you need to not go there.
I know, that's hard.
Okay. Well,
No, I get, I
we just
understand
don't.
that. I
we just don't.
I can tell them the pound sand now.
Well, that's just it.
Because what came
So-
in, we know we spent every dime.
I will tell you exactly what it is. It's in your
I know, I
report.
saw it, you told us.
$386,481.11
Yep. To
is
the penny.
owed by general fund to a combination of
All
road and
those.
bridge, capital improvement, EMS, and human
And this
services.
just is telling us.
The first of
in the
those
middle of it.
imbalances occurred in 2021.
Yeah,
We added to it in 22 and 23. In 2021, ask yourself, you were here, what happened?
yeah,
Conversion to CIC,
yeah, that did it.
okay?
We couldn't find, and then we didn't have any help once they sold the company.
So, the corrective action that I'm hoping that we will take before the end of 2025 is to clear these balances by moving the monies, repaying them to the funds that they needed to have gone
So that would be
into
an arrears.
initially,
Yeah.
okay?
Yeah, okay.
And
We haven't-
then the
do
reason
we-
I'm gonna leave this little chart with Vernon is because I know what the balances were proofed to the end of December of '24.
So we just need to back.
And so you will need to look in '25 and see that we've had no condition that served to change those balances.
So that'd be, I see some more resolutions coming in arrears there.
So when we get to the end of '25, if we've been able to resolve those and all is or go to zero, we don't have funds that owe one another, then this statement 3 here on the top of that page, I will say current status, fast forwarding a year, fully implemented.
Yay,
Okay, that's what it takes to get us there.
got it.
Okay. Item 4, key accounts not being reconciled correctly or on a timely basis, and we reference cash and other. Yeah, I will tell you, the reason we said, made reference to conversion to new accounting software is because we really had very little issue with that prior to the conversion.
That's for sure.
And we have had difficulty since. We've made some headway there.
Are you happy
By
with it, Vernon? Is it
virtue,
working?
As well as it can.
Yeah.
well,
There's, I mean, I'd like to see a conversion in the future,
Meaning
But I've
a new
also-
machine?
a new software
System.
system. But it's also very expensive. I've looked at the other systems and they are expensive,
Yeah.
so.
Well, the downside is this will eventually not be supported probably sooner or later.
Possibly.
We don't want it maybe sooner.
so where we ended up with this, current status, improved,
Yep,
okay? Improved because partly the efforts of some of our own staff and also the efforts of people assisting you from Redlands.
no, we've heard what you've all done, and then Redlands has been a great help to us.
So we're getting closer, so I said improved. This is one where I think we may be close to being able to say by this time next year, fully implemented, hopefully, okay? Item 5, payroll records. Payroll records should be reconciled to general ledger posting and resulting financial statements, as well as payroll tax return filings and W-2s. We say reconciliation should be performed on a monthly basis. Well, I think that's true, because really what this amounts to, taking your payroll journals, making sure all that information is captured and posted correctly to the general ledger. As you know, we have several funds that have salary-related expenditures. So salaries, benefits, payroll taxes, correctly distributed by fund. And then all this stuff has to match what we file with the government. Quarterly 941s, those are payroll reports for federal withholding and social security payments, unemployment, state withholdings, and so on.
Is it, I thought we were doing, or had started doing that.
We're,
There's no change?
We have never stopped filing our 941s and W-2s.
Yeah.
But it's the reconciliations on.
the reconciliation
That's-
part
that's
is what's
the key
not
part.
complete.
And is that really hard to do, Vernon, now? Is it that?
No, with Redlands, it is, we've created some processes and we're doing this.
Okay.
It's just,
So
remember.
no
we're
change
looking at
makes you think it's nothing's
2024.
happened.
We're looking at 24.
We're
So-
looking at 2024.
And we still
which
were
was-
struggling
which was
in
very
24.
difficult.
That would be the one thing I probably should have said at the beginning. So, I mean, we're 3/4 of the way through 25, but this report deals with 24, which is the focus of our
Yeah,
testing
that's what
and
we
review.
have to keep in mind.
Okay, so things that we may have done, steps taken in 25 to this point,
Yeah, work is
may
being
have
done.
already begun to address these things.
Yeah, that's what we need to say.
Item 6, it deals with, it's a fairly lengthy paragraph dealing mostly with grant reporting and accounting. Okay, but in a nutshell, this, in my view, still continues to be one of our areas we struggle. We have several people across the county that administer these grant programs. And some are pretty good about this record keeping, others not so much.
Yeah, we're transitioning, that's for sure.
So we're still in that process, I think, and I don't feel like, at least based on what we've seen through the end of 24, that our condition is much different than it had been in the
That's true,
previous.
it's the end of 24.
Okay, so maybe 25, we're beginning to get our arms around that, I hope, but previously, I don't think so. The rest of these are previous year observations. They're of probably a little bit lesser consequence or import, and so that's why they're listed separately as deficiencies rather than material weaknesses. One is reporting fuel sales and gross margins at the airport should be monitored. Well, I know that we have communication on a regular basis with the airport authority people, and that I think is a good thing. We can see that in some of that reporting that we got to look at, that they're at least providing an inventory level, fuel at the end of each period, so that's helpful. We still see margins, so in other words, costs compared to the selling price of the fuel that fluctuate pretty widely, and the margin doesn't seem to be adequate in some years. So hence the need for monitoring. But I say improve because it's clear that we're having some communication on these issues, it seems to us, at least from what we were able to observe. Item 8 deals with some really kind of some detailed posting and reconciliation questions in revenue expenditure counts, and this goes back maybe to your observation, Bill, earlier, that with this, a lot of this information comes from the state, and we have to reconcile our postings to what the state, and that isn't always easy. And sometimes we have differences because we've made mistakes, like posting actual expenditures, for example, to what's uploaded to the state. And then, although the state will not admit it, they occasionally make a mistake.
Really?
Yes, they do. So it's a reconciliation process. I know that we have a new director in that department, and we think that that will continue to improve. So I did say current status improved.
I think it is.
On the top of the next page, recording expenditure should be correct and consistent throughout the year, and then we go on with a long detailed explanation. But let me just give you the plain English version. Plain English version is, when we record expenditures, we expect that we should most of the time get them recorded in the right fund. So we're doing better there, doing a lot better
How's our
there.
going?
And that secondly, they are being posted to the correct budget accounts, budget codes. So we do still see in 2024, we still see a lot of inconsistencies. And they may not seem like they mean much because it could be a wrong budget code, but within the same, the right department, but the wrong code, but still those codes have meaning to us. So we want to be consistent as much as possible.
Yeah, it's really hard to keep thinking a year ago, because we're
It's,
three
things have
quarters of a year
changed,
through
yeah.
25 already.
And the other
Seen a lot of
thing is,
change.
have been attempting to get to a system where all the supporting data for expenditures is being uploaded to your system. So in other words, available to be reviewed and monitored electronically, not with antiquated systems where we have, physical filing cabinets and paper stuff everywhere. So based on, and once again, focusing on 24, we still see areas where we have deficiencies there, where expenditures, we had a much greater probability that there was something uploaded, okay? But sometimes it didn't correlate exactly with the expenditure.
Yeah.
So requiring then follow-up, figure out, what happened.
Well, we have a problem from the state not
So-
labeling stuff they send us. Some of them, Vernon just said, come in with no title.
Well, and
nowhere,
on the
they even know
revenue
where the
side,
money
that's
came from.
certainly true, but on the spending side, we should have pretty good control.
Well, we have
on
that
that.
control on that.
And I will say is I'm hopeful that that problem has been beginning to be maybe largely addressed in 25 because we do look at some transactions in 25, usually limited to about the first 60 to 90 days worth. So expenditures taking place in the early part of 25. And what we're looking for is to see if some of those should have been considered payables and therefore pulled back into the spending in the previous year. So obviously we can't do that unless there's documents, we can see receipts. And so our folks that did testing on those accounts payable cutoff, during that period, it looks a lot better than it had been before.
Good.
So we're hopeful that has been or will be addressed so that we can say, if not fully implemented, at least greatly improved or something a lot more positive than no change.
Yeah.
The other items there are not management letter observations, they're more in the nature of reminders. We have Tabor Reserve, as you know, that's been in the law for 30 years or so plus now. Our county-wide requirement is $309,800. We have more than adequate resources to satisfy that. And then the last thing is just a reminder, the statute requires that we do an annual update or inventory of our fixed assets. And what we should be using for that purpose, we'll produce for you a detailed listing that shows the depreciation calculations that are included in the report. And you can use that as a basis to do your updates.
Okay.
Okay. I'm pretty much out of paper, so I'm not sure if that is disappointing to you at this point or not.
No.
Probably okay. Are there questions, things about the report or things that we've talked about, or maybe we didn't touch on that you have questions about that I might be able to help you answer?
How do you feel about our cash reserves this year? Because you've made comments about the cash reserves in the past.
Well, a couple things, maybe two or three things. I guess my first answer when I deal with clients is, A, do we have deficit positions anywhere, or do we have conditions where it doesn't look like our reserves are adequate, at least to satisfy restricted obligations? Well, we're beyond that threshold, so that part is good. I would also say that I probably have not looked at it from a perspective of what would be an appropriate, for example, working capital reserve. And usually, you can do things that are fairly simple, such as, a certain number of months of your normal operating expenses or something like that. So the short answer is I don't really have an observation on that because I didn't look at it from that perspective. I will tell you this, that in order to do that, from my viewpoint anyway, two things we need to remember. One is the cash reserve here at December 31st. That's not
Accurate.
it's accurate, but it's not the same all the time. As you know, it's fluid. It goes up and down. And we have times where it's increased because our tax collections are higher, and we have periods where it's decreased. So one of the cautions would be, in my experience, is you want to manage against your low point. You look at the point in the year where the cash flow is stretched the most and measure that against your reserve. So and December 31st isn't it. So you have to kind of almost start to build a chart, if you will, a graph where you can begin to see how that fluctuates from month to month. And that will help you hone in on what a working capital reserve would be.
Because you sometimes can be required to tap into it.
You may, you may, and we do, in fact.
I know.
The December 31st number is neither the low point nor the high point in our case.
There were
It's
years
neither
when
one.
We are tapping into cash reserves right now.
Yeah, I know.
Yeah.
There's no more real tax revenue coming in.
Yeah.
I mean, this
That's right.
is exactly the time, if you think about it, so we're beyond all the, ad valorem taxes, except for a tiny sliver that's delinquent,
I
we've
think she said
collected
we
at
had
this
a
point.
couple 100,000 is all.
Yeah, it's just the sales tax that we're,
So, sales tax and other revenues, so
but
you,
even that's going down because it's not summertime.
Yeah, because of the volume.
Yeah, yeah, that'll be coming down.
true. So, and then I could say the other thing, which sounds sort of flippant, and so I don't mean for it to sound that way, but is you never have enough cash, right? I mean, it sounds funny, but really, do we ever have enough money to address all the things that we might say we'd like to be able to do? No, probably not. And and that's the reason we have Board of Commissioners to help us decide on what those priorities need to be for the county.
And take the whippings as they come.
And take the beatings as they come. So I know I didn't answer your question just exactly, but I think those are factors we would look at to develop that.
Okay.
Oh, thank you.
Any others?
Very good. Got anything, Brennan?
Sure.
You happy?
I will be happy to have this meeting next year and we have a retrospective on this year.
Yeah, because this year is a major turning point.
2024 was a very brutal.
Oh, terrible.
Yeah.
For many reasons.
Main reason is because he had 4 jobs at the same time.
Well, we've had a lot of challenges. So the main thing is, I think we're making headway, but it never seems to happen as fast as we'd all like for it to. And we just kind of have to stay the course. At the same time, there's never been a year, and I've been doing this for a while now, so I think it's a fair statement to say we've never had a year where the next year resulted in fewer demands for information than we had the previous year. Okay, I don't think it's ever happened, and I doubt that it will. So we'll have to adapt as we go forward.
So what do you recommend?
Okay.
Yep. Well, I appreciate your statement that, the first part of 25 that you have looked at is a much better outlook than what we dealt with before. And that is a direct correlation to the personnel we have in place, as well as, Kristen and Monique and us being able to actually work on the issues that we found during '24.
So,
So thank you. I think
well,
I'll take them to lunch.
yeah, as you should. We're happy with that too, obviously. We want things to go better. We want things to work more smoothly. We want to see you address some of these issues.
Yeah, and we want to address the issues. It's not that we don't want to, we want to. Because we know that it'll help us have less problems in the future.
Oh, yeah,
Exactly.
by fault.
So what's left with this? We have a few, as I mentioned to you, there's a few cosmetic changes here or there before we put it in its final form.
Fine, okay, yeah.
Beyond that, we will have to, and we'll do this electronically, send a final version to the state auditor's office that keeps you in compliance with the requirement to accomplish that feat by September 30th, so that's next Tuesday, which is also the due date for the clearinghouse report. So we will be uploading and prompting you on that as well. And then, well, this one's done.
Okay, that's good. Yeah, and then we'll definitely get together with our plan for next year to be done. Like we talked about,
Right.
start the 1st of May,
So
and
we'll
be
be
done by the end of July.
beginning to address a little bit more detail in addressing our, areas where we've had problems in the past. And then also, some planning so that we can kind of just try to move this up on the calendar a bit here also.